How would you like to learn the secrets to achieving annual returns of over 20%? It might sound too good to be true, but it's possible, and I've done it. After 20 years of research and developing my own systems, I've cracked the code. And guess what? These strategies have generated over 25% returns per year on average without overfitting. Today, I'm going to show you how. I'm going to show you the main principles behind maximizing your wealth. Most people think you can just pick a few stocks and hope for the best, but that's not the case. We need a different approach, a diversified, data-driven approach that allows for higher returns with a controlled risk. Let's dive in. The first thing to cover off is 20% per year actually good? Well, Warren Buffett annualized 19.8% a year from 1965 to 2023. And he's, apart from Renaissance Capital, he's considered the best, right? And so 20% a year is actually very, very good. You might get videos that say you can make 100% a year on FX and so on and so forth. But yeah, with a lot of leverage and you bust out after a year or two if you're lucky. But long term, you can make 20% per year, but it's pretty damn tough. And I'll show you the main principles behind it. And just one other thing is most fund managers don't beat the S&P 500, right? And that's averaged about 8% over the last 100 years or so. Secondly, you can't mess around with low return strategies. That might sound obvious, but I wasted a ton of time as a beginning trader doing things like kind of things you could see on Think and Swim and some other channels, selling strangles, so selling out of the money calls and out of the money puts, getting returns. You know, with a reasonable amount of leverage, you can make 6 to 10% a year doing that. But what a lot of people do online is lever up and make 40 to 50% a year. But then they bust out as soon as there's a crash. Because with a strategy like that, your gains are limited, but your losses are unlimited. And a phrase we have for that is picking up pennies in front of a steamroller. You know, just imagine being in front of a steamroller picking up pennies and then you get totally flattened like in some cartoon. Well, that's exactly what it's like. So to make massive returns, or not massive returns, but like 20% a year, you need positive skew securities. Something in stocks, REITs, commodity futures, and call options. Those are the main ones. With call options, a note on those quickly, you have to be very careful because you can burn through money because of the time decay. You not only have to be right on timing and price, but you have to be right on volatility as well. If you buy call options when volatility is high and then volatility collapses, you could lose money even if you're right on everything else. But they have massive upside and they do have limited downside. You can only lose how much you pay. With stocks, that's pretty obvious. You can make a ton of money in stocks, and I would spend a lot of time looking at stock screens. I mean, the market's very efficient, but with out of the S&P 500, with the medium and smaller size stocks, you can still do much better than average using stock screens like Portfolio 123 and other ones. Just avoiding crap stocks, basically. If you invest in things that in stocks that have good fundamentals and have some price momentum, and just avoid things that are over leveraged, have been going down, and have no earnings growth, just by filtering out the bad ones, you can do a lot better than the indices, pretty much obviously. Real estate investment trusts, I love those because they're a great way to invest in very diversified, very interesting real estate opportunities without having to spare $200,000 to go and put a deposit down on a property or on an apartment. You've got real estate investment trusts for everything, for data centers, for convenience stores and service stations where they have very, they're not exposed to downturns in the economy. You've got stocks like Realty Income Trust, I think its ticker is O, which has paid a dividend every year for about the last 30 years, and it's gone up every quarter or at least every half year for the last 30 years, the dividend has. And you'll be fascinated. Go to search NAREIT, N-A-R-E-I-T, North American Real Estate Investment Trust, I think it is. And they've got a REIT Watch, REITWATCH, a REIT Watch publication they put out every month that has all the data on the main REITs in the United States. And that's you can get some pretty good ideas from that. Commodity futures. So the Chicago Mercantile Exchange, the CME and the CBOT have micro futures. So you can get, so you don't need tons of money to invest in commodity futures like in the old days, even 5 years ago. So you have micro futures in copper, and Bitcoin and Palladium. That's not very liquid though. Gold, obviously, crude oil, and now in notes as well, so in bonds and notes. So you can invest in $10,000 of government bonds, where before you'd have to buy a $100,000 a security, for example. And you don't need a lot of capital in your account to do that because they're futures. So you can put down, the margin changes from time to time, but 5-10% of the overall capital as a margin, and that avoids you paying a lot of margin interest on your investments. Now, the next main thing is to diversify across different asset classes. I've just talked about stocks and REITs and commodity futures. Don't put all your eggs in one basket, right? That's actually completely true in investing. And by having a diversification, you can weather downturns. For example, commodity futures did very well in 2022, while bonds went down. Bonds had the worst year they've had for about 50 years at least. And stocks went down, but commodity futures went up. Another example is long-term government bonds in the COVID crash of the start of 2020 and in the GFC. They went up, and I made a lot of money on bonds while stocks are going down, and it balanced things out. Why that's important is because it's very hard to have solid gains in the long term if you have massive down years, right? So if you can even out some of the fluctuations, that also helps you add leverage, because instead of having 30% down years, you're having like 10% down years. So you're like, okay, well, I'll leverage up a bit more. And so if I'm happy with 10% down years, I could double my leverage and have 20% down years, and you don't quite get double the return, but you get a lot more return as well. And you can only really do that if you're diversified. Just being in REITs won't do it. Just being in commodity futures definitely won't do it. And just being in stocks definitely won't do it. Look at what happened in the tech crash of, was it 2001 with the NASDAQ? That went down something like 70%. So you need to be diversified. And you need different systems as well. Diversify amongst systems. And one of my favorite sets of systems is the concept of trend following. And I have lots of trend following systems. And they're great because they get you out of, if the market's going down, it gets you out. Trend following systems can give you less return overall, but they cut the downside. So then therefore you have a smoother equity curve, and then you can lever it up. And so you can lever it up to get the same or higher returns than just buying the raw stock or the raw REIT, but with less drawdown. So it's much better for your portfolio overall. Now, how do you combine all these different systems and securities? I use mean variance optimization, but it can be a little bit complicated, and there are ways to make it robust that some people argue about, but I'm happy with the way I do it. But just even weighting. Just if you equal weight things, there are lots of studies that show that's almost as good as the more complicated ways of balancing your systems and balancing your investments. Sometimes simple is powerful. Don't overcomplicate things. Next thing is the importance of consistent execution. It's important to exactly size your system. So let's say you've decided on equal weighting of your systems and of your different of REITs and stocks and so on. Stick with it. And for example, let's say your system says to put $10,000 into a certain stock. And you say, oh, well, $7,000 is 10,000, 7,000 doesn't really matter. Well, it does. And by just being a bit, that's something you can control, right? Your sizing, you can control that to the dollar almost. So you want to control these things. Your system says to put in 10,000, put in 10,000, not 7,000, because there are so many things you can't control in investing. You need to control the things that are within your control, such as sizing, and being consistent about that. Because what if that $7,000 stock was, or the one you put $7,000 into was one of the big winners? You would have left a lot of money on some money on the table, and you do that over and over again, and it adds up. A small mistake can make a huge difference. Next is watch out for execution costs. You have to have a low-cost broker. You have to have a broker that doesn't trade against you. I mean, quite a lot of them probably do, but transaction costs really add up. When you do back testing, you can see that. If you have a system that trades very frequently, the difference between paying, say, 2 cents a share to half a cent a share can be just massive. It can be like 5% a year or 7 or 8% a year over time. You'd want to avoid trading illiquid securities as well, because they often have a big spread between the bid and the ask, and that can that can really hurt you. So you want to trade things that are generally pretty liquid, or if they're not very liquid, don't trade them that frequently. Know the hidden costs, or they'll eat into your profits. Now, probably lastly, stay focused and don't panic. And one of the first videos I did was about trading psychology, and it's absolutely critical. If you panic, say in March 2020 at the bottom of the COVID crash, you would have missed the massive boom that happened when the government started, governments all around the world started giving money to their citizens, and then a lot of people put that into the market, and a lot of institutions came back into the market, and the stock market boomed. So it's fine to be a bit fearful sometimes, but when you're fearful, just listen to those feelings and look at your systems, look at what you're doing, and just make sure what you're happy with your sizing, make sure you're happy with your systems, and then just execute. So a summary of some of these points: focus on positive skew strategies and positive skew securities. So not short options. You want to be in stocks, real estate investment trusts, commodity futures, and call options, I'd say. Multiple diversified systems for these different things as well. So, for example, you can have different trend following or systems for stocks, or you could have systems that just rely on fundamentals. Diversify those approaches as well. And for commodity futures, you could have systems that are based on the slope of the futures curve, or systems, or again, trend following. And for each security type, there are ways of doing it. For example, with real estate investment trusts, you probably don't want to be in them when interest rates are going up, because that's really bad for real estate investment trusts. And you can test that, and there's a free tidbit for you. Stay consistent with your sizing. Keep learning. Don't stop learning. And like I said, if you're get a bit fearful, just check your work and don't freeze. Just keep on going. If this has been useful to you, have a look at my Patreon channel. There's a link down below. I do personal coaching on that, and sometimes divulge systems down there. And please subscribe if you want YouTube to notify you of future videos. Thank you for watching.